Today we have three speakers, Evan, Dana, and Alisha. Thank you all so much for joining us. First off, I'll have you each give a brief introduction of yourselves, the companies you work for, and let us know what type of startup funding you have experience with and what types of founders should be reaching out to you. So I'll pass it over to Evan if you want to go kick us off.
Certainly. So hi, everyone. Good to see a couple of familiar faces in the crowd. My name is Evan Hamilton, born and raised here in Los Angeles, went to undergrad in New York, studied anthropology and sustainable development at Columbia, wrote my thesis on the chess players of Washington Square Park, which was a lot of fun because I basically gambled in a park for a year and then wrote a paper about it. Then after that, I did a research fellowship in organic geochemistry, looking at the environment over the last 100,000 years. Realized I didn't want to get a PhD in paleoclimatology, so traveled around the world, did 31 countries in 5.5 months, moved to San Francisco, worked at an electric motorcycle startup doing strategy and marketing, came back down to LA where I was a senior advisor at the Los Angeles Clean Tech Incubator, realized I wanted to do ventures, so went to MIT, got my MBA, spent the summer in between working at Alisha Capital as a Pledge LA fellow, which is a great organization, not just saying that because Celeste is in the room, but also I spent the second year working with Homeboy Industries to stand up their impact investing arm. So I'm at Upfront Ventures. We're the largest early stage investor in Southern California. We have about $2 billion in assets under management since 1996 across 6 funds. We invest in pretty much everything. We're very generalists in that regard. We have a different partner who covers different elements. I really like the overlap between deep tech, urban tech, and consumer areas, but there's someone here who does everything. We like to write $2 to $4 million checks at the seed round, looking for 20-25% positions in companies, taking board seats, and helping navigate through the valley of death. Other than that, I play the ukulele. Did I miss anything?
No, that was awesome. Alisha, if you want to go next.
That is a tough act to follow. Nicely done, Evan. So my quick background, I spent a decade in the startup world myself as an operator. So I was COO, CFO of 3 different startups, helped to build, scale, sell them, kind of saw every kind of outcome there, from small private sale to taking one company public, and have a bankruptcy in there to boot. So I really did have every kind of outcome. And I also took investment capital from a lot of different sources, whether it was angels, it was seed, large series, A's and B's, and then, as I said, took one company public. So over that decade, I developed a lot of opinions about what is and isn't working in terms of how companies get funded and who gets funded. And so 2 years ago, I decided to move to the investor side of the table. And I wanted to try and address what I saw as a big problem, which is that there are very few women and people of color receiving investment capital. And so I founded Daintree Capital, not just to focus on underrepresented founders, but to do it through a different investment mechanism. And that investment mechanism is working capital loans. So we write checks that are a heck of a lot smaller than the ones Evan just mentioned. Our checks are $10,000 to $50,000, and they're used for very specific working capital needs. Funding inventory, helping to stand up a team before a client project starts, expanding into a new geography, funding advertising against a product that has strong margins, et cetera. So if there's a very specific, concrete investment you want to make that will drive revenue, then our loans can be used to help fund that. So we've been around for 2 years now, and have done 36 loans as of this morning, and are actually looking to grow exponentially this year, raising additional money in order to build a bigger balance sheet against which to do those loans. So that is me.
Wonderful. Thank you, Alisha. And then Dana, I'll hand it off to you.
Thank you. So my name's Dana. I am the accelerator lead here at KidsX. KidsX is one of the world's leading digital health ecosystems in the world. And what we do is we really focus on innovating within pediatric. How we've done that is actually we've built our own accelerator program, and our flagship is focused on companies that are interested in entering pediatrics or are currently in pediatrics, and we support in scaling those solutions to hospitals. Another way we kind of continue to accelerate pediatric innovation is we have a consortium of 30+ children's hospitals from around the world. They serve as mentors, they serve as pilot testing sites, they serve as pretty much a way for them to actually communicate best practices and discuss the pain points that they are all commonly having in their own organization. We go off of a reverse pitch model where we represent the voice of this consortium of these children's hospitals, and that's how we pretty much source our the startups that we look for. We focus on B2B software solutions, typically interested in selling to hospitals, healthcare organizations, or even payers. But the sweet spot for us is really looking for companies that are continuing to scale, and they already have a little bit of traction. It could be 1 to 2 enterprise customers or contracts that they already have going on. Or it could also be an existing revenue that they already have to show that they already have completed the product market fit, and they're onto that next level, wanting to continue to build their traction. The types of the stage of companies that we look for we've worked from pre-seed to Series C companies, so that's a big range. It just depends on the organization that we're working for. So like I said, we have our own KidsX flagship program, but another part of our programming is actually managing, building, operating other corporates' accelerator programs or innovation challenges. So for example, we actually built AWS's first healthcare accelerator this past year. And that was general digital health, and they were looking for growth stage companies versus our typical early stage companies. We don't invest ourselves. But what we do is that we have a wide network of investors. We have connections within, again, like primarily the healthcare space to point our companies to. So I operate as an operator here, and I'm excited to talk to everyone here and answer any questions.
Awesome, thank you. That's very exciting. And thank you, Evan, Alisha, and Dana for those intros. I also just wanted to mention really quick to everyone, feel free to write in the chat if you have any questions that you think of or come up, any follow-up questions during the panel. We'll try to find time to answer them, or if not, you'll definitely get a chance to ask those in our breakout room portion at the end. So to kick it off, my first question for our speakers, and this is a pre-submitted question we actually got a lot of founders wondering, was where should they start to find funding when they're in the beginning development stage of starting their business? So they just kind of got off the ground, getting some traction, and they realize oh shoot, I'm gonna need to start looking for funding. Where should they start?
I can hop in really quickly. So I think when you speak to a lot of venture capitalists, most will say hold off on venture capital dollars as long as possible. As if you can, especially as you're getting started, I think there's a lot of opportunities for grant funding, for SBIR grants, for university funding, prize competitions, all of the different ways that you can pull together non-dilutive capital is definitely the way to go for as long as possible. And then as you start to think of ways to start bringing in more funding, I think it really needs to match towards what your company is needing and also signaling in terms of your growth as well. I think that there's a sweet spot to find with we're raising something big enough so that we can keep the lights on and that we can really scale as much as possible, but also being incredibly capital efficient and not asking for $10 million out of the gate when it's really just, you know, a working MVP. Though obviously, if we read TechCrunch, we know that that happens more often than not. So yeah.
Yeah, I would definitely echo Evan's sentiment of like holding out on VC funding. So I mean, so just like some background too, like in the past, I've built a community ventures program where or individuals who had an idea, they're able to actually build it out from on paper all the way to that actual product. And so just to kind of level set too, like non-dilutive funding is being able to maximize your control or your own equity within your own venture. So through that, I think that being able to look at potential donors, leaning on grants, loans, crowdfunding even, that actually be something that is super helpful, especially when you first start your business. So then you're not actually having to turn towards dilutive funding, which is you actually selling shares and equity of your company. And so with that actually is more geared towards like, you know, you can turn to angel investors, there's equity crowdsourcing, and it just varies in that sense, or VC funding. But recently, like KidsX ourselves, like we actually ran running a local innovation challenge called the VaxUp Innovation Challenge. And so we actually offered a grant opportunity for companies to actually build, test, and deploy a solution to increase vaccination rates for the youth in LA County. So like this is like a good opportunity for entities like nonprofits, CBOs, startups, or any organizations that may be interested in looking for non-dilutive funding. And it could also be less stress on the founder because typically the funding provider, they're not too worried about generating revenue or returns, but they're focused on the purpose of the company.
I would just add, don't forget to look locally. I agree. If you can start with grants, that's the right place to start. There are often like, you know, small grants, $5,000 here, $5,000 there, that may be available through your city, through your county, through your state. And sometimes there aren't all that many people applying for them. As soon as you go for the national grants, like there's a ton of competition. So I would make sure you spend some time looking through your local chamber of commerce or anything at the local level to see what grant options are available. And then the other thing I would say is, you know, there certainly are a lot of great companies out there that have received venture capital money, and that has been a fantastic path to growth for them. But don't assume that venture capital is the only path or right path for you, right? It really depends on the kind of company you're building, and it depends on, you know, what your goals are in terms of how fast you want to grow, and you know what trade-offs you might want to make. If you want to be a unicorn and you want to chase hyper growth and you're looking at mega markets, like by all means, you know, venture capital is the way to go. But if you're looking to, you know, build a company a little bit more slowly and are more focused on near-term profitability, there may be other ways to fund the company that make more sense.
Totally. Thank you. That's a really great tip. And kind of speaking on that same vein, like another question we got was, how do you define traction? Because a founder mentioned like a challenge they have is that all investors kind of seem to define traction very differently. So what types of things should they be looking at when defining that traction and presenting that?
So I can kick things off. What I would say is, yes, everyone defines it differently. And some of that is that it's industry by industry. And some of that is it's investor by investor. But I do think it is largely industry specific. And I think it is why it's good to start having conversations with investors before you actually are asking for money. Because one of the first questions you should be asking is not just, would you invest in a company that looks like ours, but what kind of traction would you need to see in order to make that investment? And then you go back to your model and you figure out, okay, what would I need to do to get there? And then you figure out how much money you need to do that. And one of the mistakes I've often seen founders make is they raise money at these nice round numbers that they hear other people raising money at. Oh, I'm going to do a 500,000, pre-seed round. I'm going to do $1 million seed. I'm going to do a 5 million Series A. They hear these numbers and they kind of assume that that's what you're supposed to raise. And what I would encourage you to do is work backwards from important milestones that you want to hit. What is the key milestone that would increase your valuation significantly for a subsequent round? And how much money is it going to take to get you to that milestone? Go raise that amount of money. Don't raise some nice round number. Raising too much money early hurts you because then, you're taking on more money at a lower valuation. So I would really reverse engineer how much money you raise by the milestones. And I think those milestones can be informed by having conversations with investors about what their traction metrics are.
Yeah, I really agree with the last point on that one. I think that it is, one might feel like they have to have KPIs around LTV to CAC or all these different buzzword numbers that people have in a data room. But I think you as the entrepreneur know your space and your industry a lot better than we probably do. And so you can inform us as to what are the numbers that really matter and how you are attacking those, because that's going to inform how you're going to, be able to move into other markets or add in new product features, all these elements. I think that there's also a key difference between traction and product market fit. So traction is really a signal to say, these are the things that we've been noticing, these are the things that we've been building upon, and these are the hypotheses that we're getting proven out, but it's just kind of a heuristic for those things. Whereas product market fit, I really actually just kind of lifting it from Michael Seibel at Y Combinator. Product market fit isn't when you have 1,000 subscribers. It's when your company is doing so well that you're actually concerned about people paying you money because it's actually breaking your company. And so that's true product market fit, where you just like, we need to take in more money in order for this thing to actually operate at full speed.
I echo both Evan and Alicia's sentiment on, traction is defined very, very differently. Our own organization defines it differently within the challenges and programs we run. The one particular, program could be looking for multiple contracts, like the number of contracts matters, or the number or the actual revenue or the ARR that matters too. But it also is very dependent, and exactly what Alisha said, like ask. It's not necessarily a secret by any means. And if anything, like those are the criteria that is used to make sure that whoever the investor, the organization, whatever you're applying for, you're a good fit for that particular program or for that particular that partnership or that working relationship.
Awesome, thank you. These are wonderful tips. The next question I kind of wanted to address was involving businesses that are more like brick and mortar. So we got a question, someone saying like, I'm a startup leaving the idea and proven concept stage. Where would you recommend getting funding for a brick and mortar store?
I think Alisha kind of hit on it beforehand, is if you're a local brick and mortar, looking at local chamber of commerce, Bixel Exchange here is really connecting the dots on those elements. So I think that is definitely one of the ways to go after it. There are also angel syndicates in some regions and areas that people are connected to from a personal standpoint, because they live there or they have some common background with whatever that mission is going to be. And then I think that there's a lot of interesting things around alternative investment vehicles. So like inventory finance is super interesting. So taking that brick and mortar and parsing it out into the different elements of how you can get funding for it. So if you have inventory financing for the element that's over here, and maybe there is some economic development funding that you can get for the workforce that you're using on this side. And then, from my time working with Homeboy Industries, being able to get procurements contracts for city and county that are, if there's maybe a impact elements, workforce training elements of that as well. So that's probably how I would go for those things. And then as you scale, maybe there are strategics of, if you are a let's say a beauty company, maybe there is Revlon or Sephora or someone who's trying to expand their footprint, so you can maybe get funding from them to have a strategic distribution hub for them as well.
I would add into that too, to check about economic development incentives, because I think where you base your store might also unlock some additional opportunities. I know I'm in DC, and certain zip codes literally have not just tax incentives, but sometimes some cash incentives to build or open a store there. And then also in terms of physical stores, landlords, right? Like landlords will actually help finance some of the build out sometimes. So I love Evan's part about parse it out, right? You might be able to get different kinds of funding for the different pieces of it. Don't put it all into one big bucket, but instead, the build out maybe can be landlord financed, maybe, the inventory can be, financed through a different person. Break it all out and see if you can piece it together that way.
I am actually less familiar in this space because I work with digital solutions for the most part, but from a side of, I also am a boxing coach, and the owner that I work with, he actually is scaling his business now. So just kind of seeing on a more like personal level of like how he's doing that. He really puts a lot of weight in just understanding the terms and expectations from the funding provider itself, whether that be the landlord that he's going to rent from, whether that be the angel investors or the just typical VC investors that are expecting him to make sure that he's churning out, like his churn rate be this, his return be this, his revenue be this by the a certain time period. It all matters, because you don't want really like stressful people on your cap table. And if it's non-dilutive too, like the funding provider really does, the relationship with the funding provider really still does matter at that point as well.
Totally. Thank you. Thank you for sharing that. That's very helpful. And now I have kind of an individual question for each of you, a little more suited to each of you, but also if others have like comments, feel free to jump in. So first for Evan, I was wondering, how do you start, what's the best way for founders to start to reach out to investors and kind of like form that connection, or just start that relationship when they don't really know them or aren't really in those spaces to begin with?
Yeah, so I think that there is maybe a cliche truism of, if you ask a VC for money, they'll give you advice. If you ask for advice, they'll give you money. And so I think if you're trying to establish a relationship with an investor, I think really being able to start that conversation earlier on before it we have 30 days of cash left before the lights are going out, kind of thing like that. Really starting to say, hey, we met at Grid 110 events a few months ago. I had an idea that we had mentioned in a breakout room. Putting together my first deck, was wondering if you could take a look at it at that point. And so then by the time that you are going from, getting the SBIR loan and putting your business in an economic development zone and all of these, and getting pre-seed and all those different steps, then when it's at my stage of 2 to 4, or someone else who's downstream from me as well, they already have data points along the way to create this line of an arc, as opposed to needing to make a decision in that moment. So informal, long tail is probably the way that I've gone about it.
Awesome. Thank you. And Alisha, I was wondering, what is the best way for founders to approach you? And what type of criteria do you look to determine your loans for these businesses?
Sure. So Daintree is focused on trying to help companies get over that $1 million revenue hurdle, where there are a lot of other funding opportunities available. So our sweet spot is companies that are 100,000 in revenue to $1 million in revenue. If you're pre-revenue, debt isn't a great fit yet. I mean, you're going to be looking at more things like convertible notes, which is really, equity disguised as debt. So, I do have to see a revenue track record, because it has to be believable to me that you have enough cash cushion that you can repay a loan. So 100,000 in revenue to $1 million in revenue is kind of our sweet spot, though certainly we've funded companies above that $1 million revenue mark. And then really what I focus on is unit economics. So I do a deep dive into the unit economics of the business to really understand, is there a profitable business at the core here? And what do those unit economics look like? And is there a specific growth investment that's going to help you unlock those economics? So, usually looking at things to make sure I understand the margins and I understand what drives improvement in those margins. So maybe, for example, you're buying inventory and that inventory is selling pretty quickly once you have it, but you're having to buy at the manufacturer, minimums that don't get you to better, cost structure. And if you could buy twice as much each time you place the order, you might hit a different step function in terms of the manufacturer's prices that would allow you to improve the overall economics of all of the product you sell. That's a great place for debt to play, right? So you're funding a 3, 4, 6 month investment in buying inventory in bigger buckets. And yet what it does is it unlocks better margins for everything. So that's the kind of place where I think debt plays really well. But so what I'm looking at is those unit economics. I'm looking for enough track record in terms of revenue that I feel that there is enough of a customer pattern there and cash coming in that the debt can be repaid. What I will mention too is that there's some things I'm not looking for. It's fine if they're there, but a lot of equity investors are looking for that, 10x return, right? They need to make that, portfolio return. And so they're looking for exponential hyper growth. I don't need hyper growth. I need profitability at the unit level, and I need growth, and I need sustainability, but I don't need hyper growth, and I don't need mega markets. So those are the two things that are, that are a little different, where I can support companies that maybe aren't a great fit for venture capital.
Awesome. That's really great. It's super exciting to hear what Daintree Capital offers. And Dana, for you, I was wondering, what are some trends that you're currently seeing in the healthcare space that up and coming businesses and like the healthcare and wellness spaces should kind of be like paying attention to right now?
Yeah, so obviously we're in a pandemic, and COVID really played a role in the funding that we saw this past year. So digital health, the digital health space is very hot right now. Funding among US-based startups it set a record this past 2021. It doubled from 2020 to 21. And it was about $29 billion this past year. And the year before it was about 15 billion. And some spaces that have been popping up on my radar a lot, mental health. I've heard it from different stakeholders on the hospital side, on the more underserved population side, the consumer themselves. So this seems like a space that has been very, very prominent, and there's been a lot of investment that has gone into this space. Certain types of solutions that I've seen are more in the digital therapeutics space that actually delivers mental health. There's also a lot of the marketplaces that have been popping up, and more funding have been going towards that too, to support the staff and caregiver burnout, because there's just a lot of the providers are overworked, and their satisfaction levels have been decreasing just because of the hours and the stress that has and the burden that has been put on them because of the pandemic. So there's been a lot of digital solutions that have been trying to target that and connect other providers in different areas to other areas to actually support other organizations and healthcare organizations. And then lastly, another big topic too is home health. A lot of these solutions, a lot of consumers want the healthcare to have met them at home and be able to actually start thinking about like how can you deliver it easier and make it more accessible to the underserved populations. And so they're really expanding on that space. And then also remote patient monitoring within that space has been pretty big as well.